How's it, guys? Welcome back to another video. Today's video is about one of ICT's most powerful and advanced strategy, which is the turtle soup. We will look at what is it, how to spot it, and how to trade it. But before going to the video itself, let's subscribe to the channel, comment, like, and share this video with your friends and family, right? So let's start with the theory part of the video first. Okay. So what is the turtle soup? The turtle soup strategy is premised on trading external or internal liquidity pools, mostly external, because it's about trading the highs and lows, both external to internal or internal to external. This strategy is powerful because it is not premised or based on other ICT concepts. All you need is a high or low taken, then take a trade to the opposite direction. Because as ICT says, the bias of the day is both bullish and bearish. So when the market takes buy side liquidity, we expect the market to gravitate toward the sell side liquidity. So a bearish turtle soup is when you wait for the market to take out a high, then you sell. Or the bullish turtle soup is when you wait for the market to take out a low, which is your external liquidity, then you buy. Just like this. When the market comes to this buy side liquidity here, because there is a ton of buy stop that are resting here, so you are trading this liquidity. Even here, there are tons of sell stop here, so you are trading this liquidity. As soon as the market take out the low here, and when your bias is bullish, not so this is based on bias. When your bias is bullish and you see the market taking out external liquidity to the downside, then you expect the market to go back up, so you buy the liquidity pool. Same as here, when your bias is bearish and you expect the market to be bearish and you see the market taking out a high and tapping into the buy side liquidity, then you take out your sell, right? So that's the theory part of the turtle soup. Let's go to the market and look at a few examples. Okay, guys, our example will be on the US 100 on the daily time frame, which is Nasdaq 100, right? So what are we doing on the daily time frame? On the daily time frame, we're looking for our bias. So what is our bias? On the daily time frame, we see the market making a series of higher highs and higher lows. So this high, this is a low. A high which is higher than the first high, and a low which is higher than the first low. So the market is making a series of higher highs and higher lows. So the market tells us that it's in a bullish state. So the market is going up. So our bias here is up because the market is keeping the lows and attacking the buy side liquidity. So even when we come here, we realize that we have this high. We expect the market to come and take out this high and not this low, right? So now our bias is bearish. So now we know that we have to buy. Now let's go to the lower time frame and look for our buy side liquidity and sell side liquidity and how to sell the market and buy the market, right? Let's go to the 15 minutes first. This is the structure of the daily time frame, right? So we have the daily high here and you have the daily low here. You have the daily high here and you have the daily low here, right? So the market is making a series of high highs and higher lows by breaking structure to the upside. So this becomes our draw on liquidity. So you wait for the market because our bias is bullish. Wait for the market to trade back into, take out the buy side liquidity, then go into a discounted market on the daily time frame, something like this. Let's go to the daily. On the daily time frame, you'll have this and you have this as your internal liquidity. Why is it internal liquidity? Because our external liquidity is down here, because our external liquidity is this low that is responsible for this high. So you have a high here and you have the low here, and you have the high here, then you have a low here. So this becomes our internal liquidity and this is our external liquidity. So now what do? We wait for the market to take out this high on the daily time frame, then come and take out this internal liquidity on the daily time frame. So this internal liquidity will be somewhere in a discounted area. So if you look at this low here, this is the daily low and this is the daily high. So this is equilibrium, this is premium market, this is discounted market. So we want to buy in a discounted market and sell in a premium market. So whenever the market takes out this high, all you have to do is you have to take out your position, the short position, and you buy here. This is the market, so this is the candle that you're going to buy at, right? You can place your stop loss where you want to take, and you target, let's target this fair value gap at this equilibrium, right? So but because now we're trading liquidity pools, you have to target the internal liquidity, internal sell side liquidity. So when the market takes out this buy side liquidity, all you have to do is sell it to the next internal liquidity. But for me, because this is not realistic, because if you take a position like this, why are you going to put on your stop loss, right? where do you put on your stop loss? Because you don't know how further the market will go. You may take your position here, and you may be right that the market will come to the internal liquidity here, but you don't know where you place your stop loss. So for me, in order to make this strategy more powerful, I go to a lower time frame, like the 5 minutes time frame, and here I look for a market structure shift. I know I said this strategy is not premised on market structure shift, but it's always important to incorporate other ICT concepts into other ICT strategies so that the strategy becomes as powerful as you want it to be. So if you look at here at the 5 minutes time frame, right? We have this market structure shift. We have the market making this high, then the market making this low, then the market failing to make, let me do this, the market failing to make a high, and instead it makes a high low. When this is our first clue that the market is now turning to go bearish, right? So, and we have the market breaking this structure to the downside. As soon as the market breaks this structure, right? The market break this structure. All I have to do is take out my sell position at the next candle here. That's when I sell the market, right? And where do I put my stop loss? In order for safety reason, I put my stop loss just above this previous high, right? If you want, you can put your stop loss above this high, but I think it's more safer to put it above this high, because this high will become a protected high. We do not expect the market to come and take out this high before taking out the internal liquidity from the downside here. We don't expect the market to come to this high before coming to this lows here. So you put your position here and you sell all the way to the external liquidity, because what you are buying, you are selling external liquidity and buying internal liquidity. So you sell at the premium market and you buy back your position at a discounted level, right? So your position is going to be something like this. So if you realize that, this is how your trade went. And because our bearish is biased on the daily time frame, so our bias is bullish on a daily time frame. As soon as the market takes out this high here, now we expect the market to do what? We expect the market to go up and take out the daily high, which is this. This becomes our daily high. This is our daily high. So we expect the market to come and take out this daily high. So now we are no longer bearish, but we are bullish because our daily bias is bullish. So now what we do is wait for the market to take out the internal liquidity, which is here, and again, for me, I like to use a market structure shift. Wait for the market to create a market structure shift, which it created by breaking this high here. By breaking this high, as soon as this high was breaking, you take out your FIB, you look for your discount and premium, and you look for your PD arrays in a discounted market. So you have this propulsion block here. You buy at the 50% of it, and what do you target? You target the daily high. Why? Because the daily high is our external liquidity. So the market will move from, then you put your stop loss below this low, because there's no need for the market to go below this low, because the market is moving from internal liquidity to external liquidity, or from external liquidity to internal liquidity. That's how you trade the market, guys. So that will be the end of the video. If you have enjoyed this video, please consider subscribing, liking, and sharing this video with your friends.